Well, we probably just have a record quarter this quarter, basically, which we just finished. And from here, probably growth will tend to go down. We also see that the PBOC and the government tries to deleverage a bit more. So taking the foot off the gas, I will not say put it on the brake yet, but taking it off the gas, we also think that probably the credit impulse itself will start to turn flat negative by September, and this will show up in growth numbers. I would say the PMI numbers itself, nothing to concern. We still think it's a positive environment for earnings growth for China. It's a positive environment and reflection also that export probably will start to pick up, and that's what we have seen out of the more official PMI numbers. Now the private one here, a bit on the softer side, but let's see how this will develop over the next 1 or 2 months.
Right. I do want to get in your sense on how you are looking at your asset allocation strategy right now in this environment when we've seen a great 2020, a relatively quieter Q1 2021. And so how does that set stage for the remainder of the year, Q2 onwards?
I think last year and this year will be quite different. So last year was all about the virus, lockdowns, the recession, and we had a huge rally created out of this monetary policy support. And this year, it's much more about the vaccines, and we start to see the big effects in the US, Israel, the UK. So these countries are leading the vaccine effort. But also Europe is catching up. Germany, France surpassed 10% penetration with the first shot. So that's positive signs. And I do think this will create more story about reopening. It will be also about the story about rotation. So probably your winner of last year will be not the winners of this year. And that's what we already can see. So we tilted the portfolio a bit more to the reopening up story. We bought financials, we bought energy stocks, for example. We still like some of the tech-aspired markets like China, for example, where we think that the market maybe has corrected a bit too much over the last couple of weeks. But that's how we basically place the portfolio currently.
You just said that you like energy stocks, which brings me to commodities, Adrian, which have been riding high on the reopening and recovery theme. Very strong start to the year. The question is how much more they can run. Now, of course, we've got this infrastructure plan being tabled. Whether or not it gets through Congress is another question. But if indeed it does, over the next 8 years, how much more of a lift could it give commodities?
Well, in particular, if you look at the oil side, which is our preferred commodity at this stage, we actually think that oil price can go up to $75 over the next 12 months. And the reason is really that probably supply will stay tight, and we have the OPEC meeting today, so more information there. But at the same time, demand is starting to pick up. And you can see these trends already in the US, where we see leisure travel actually starting to recover very, very quickly. We also think that Europe, if you look at the UK bookings for the summer, also picking up. And just think about personally, the first thing you want to do after some of the lockdowns and restrictions are basically taken away. You probably want to travel, you want to see your family, or you want to go on a nice holiday. And so that will create also a pickup in demand. And I think tight supply and pickup in demand will create higher oil price. Now, oil price itself is very volatile, so we prefer to play it via the equity side, where I think not everything has been reflected yet at this point.